So let's start with the one that was up gigantic. Let's start with Amazon. Today, Amazon effectively won half of a defense contract that most people assume would go entirely to Microsoft. $10 billion win, huge gross margins. Makes a ton of sense for the Pentagon because it's based on cost and quality of Amazon Web Services, the best in the industry. This is the house that Andy Jassy built, so the contract makes for a nice present on the day when he takes the reins as CEO. Of course, Amazon hasn't exactly pulled back, just made a new all-time high today. That's okay. The momentum in the stock is as strong as I've ever seen it, and people like to buy momentum. Plus, and this is what I think is really important, you know, it's only up 13% for the year. I mean, it's nearly 3 percentage points behind the S&P 500. You're not buying this thing at an outrageous increase versus the S&P. Why is that? Well, a lot of people are still hung up on this pandemic versus non-pandemic false dichotomy. You just need to put all that out of your head. The so-called pandemic plays have spent the last month and a half roaring higher. More on that later when we talk about the biggest winners from the second quarter. Very counterintuitive. Amazon's doing incredibly well right now because the business they took during the pandemic is sticky. Once you abandon brick-and-mortar stores for the web, you don't go back. Everything else is extraneous. Now, the big issue with something like Amazon is that people want to say, I missed it. I mean, isn't that the big objection? Now, but you know, you could have said that same thing thousands of points ago, and you still would have been dead wrong. Don't use that as an excuse. You can't ever catch this one right. Now, I remember when I first bought Amazon for my charitable trust. Then President Trump had just trashed it viciously, ripping. They said he ripped off the post. They ripped off the post office, even though it had been an even-handed transaction. I was on vacation. That's a real nice place, and I decided to jump on that 300-point decline to do some buying. Then the stock dropped 200 points more the next day. I bought more, but I can tell you it sincerely wrecked my vacation, and my wife hated me for it, even though we had to pay surge pricing, and it was a miserable time in our lives because of this probably too much information. Anyway, that was more than 2,000 points ago. I still remember the vacation as miserable, but hey, good for charity. What else works in this category? How about Apple? Now, this is a high-quality company with a pristine balance sheet and fantastic customer loyalty. Look, there's no rocket scientist what I'm doing here, okay? It managed to withstand today's beatdown. Even though Apple's only down a few bucks from its 52-week high, it has underperformed the S&P 500 year-to-date. It's only up about half as much, even though it's a better company than nearly everything else in the index. I've told you time and again, own Apple, don't trade it. It's more than ever has this one been right. Stock's running because an analyst said it does better in July ahead of a new launch. Wow, I don't care. I think today's strength shows you Apple's potential if the market hadn't gotten hit. You buy strength in this tape. It bothers me tremendously that at 120, 119, 118, people came on our air and said it's not worth buying. There's no catalyst. I would like to expose those people and defrock them. They are charlatans. There, I said it. All right. Yeah, do you think someone right now is saying, I think you called me a charlatan? Good. All right, now I should mention some of the ransomware stories, too, because of this weekend, more cyber theft. I am still backing the cyber plays even here, but they do tend to trade down 3 or 4 days later and are better buys than when cyber theft is not top of mind. So they do not get included in the stocks that rallied when so many others fell. What about the second group? Terrific stocks where you've been waiting for a pullback. Okay, what does that describe? Oil. Oil went to 76 this morning, highest it's been in ages, before pulling back 74 later in the day. Soon, though, despite today's decline, here's what you're going to be hearing. The drumbeat for 100. We do have much more demand than supply, so it can happen. You need an oil company here that's got a disciplined management and a variable dividend that allows you to quickly profit from higher prices. So, therefore, you need Devon, which was down nearly 5% today. God, I love that. Even as this one of the year's best performers. Think of it as a rare chance to buy a stock that's on a roll. More on this one later, but you can't say, oh, no, Devon's down, I don't want to buy it. You have to say, oh, no, Devon's down, I've been waiting to buy it, here it is. Finally, group 3, the stocks that had the positive catalysts today, like analyst recommendations, and would have been up huge on any other day. Textbook. American Express. This morning, Goldman Sachs recommended it, and the stock quickly traded up $3 until the buyers realized there was no need to chase because Amex would inevitably get dragged down by the weakness of all the other financials, even has nothing to do with J.P. Morgan, Goldman Sachs, or the rest, or, of course, Didi, aside from being in the same ETFs as the banks. The recommendation was solid. May was an inflection point for American Express. We know that because we had them on the show. Remember when CEO Steve Squeri spoke to us at Bar San Miguel, my small plate Mexican place in Brooklyn? He said business is extraordinarily strong, just from small, medium-sized enterprises. Imagine what will happen when international travel comes back.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.